Well, great. Can you hear me? Great. Thanks, Matt, for the introduction. I think we're all getting old because your memory, while it's good, I think that had to be way over 20 years ago. But anyway, it's been a great industry to practice, and really the best thing about the practice is the great people that you meet along the way. And I would say I work globally, but my favorite market by a long shot is the Greek market. And I've been in this market for a long time and have developed a series of relationships with a lot of wonderful people, many of whom are in the room, and so it's great to see a lot of friends. And I'd say no relationship can top the relationship that I have with John. So this is a tremendous honor to be able to speak with you, John, privately, publicly, and talk a little bit about, the story of Danaos. We'll talk a little bit about the past, but I think people probably are more interested, just given the uniqueness of your window, to talk about the present and the future. But it has been quite a ride, and I've been very lucky to be in the same roller coaster car as you. And I think we've entitled the roller coaster for 10 years. Again, directionally, we're right, Matt. But it's really been, sorry, Matt, but it's been really 15 years or more. The Danaos IPO, John, was in 2006. As you know, we were, when I was at Merrill, the lead left underwriter on the transaction. It was a fantastic transaction. It was well absorbed by the market at $21 a share, if my recollection is correct, and the valuation was about $1 billion, and quickly thereafter, the stock had a value of $2.4 billion. So the first part of the ride was a joyride. I guess none of us, John, could have seen the financial crisis, because you had Architect, a company that had an amazing foundation, a lot of new builds, a long-term charter book, but I guess none of us could have seen the debt crisis that happened in 2008. So maybe you could talk a little bit about how you got through that first crisis.
Yeah, thanks. Thank you, Mark. With Mark, we had, an amazing trip together for many years, since 2006 that we met first time. And we had him together with us when we did our, let's say, the first major refinancing in 2010. And then, of course, in our other major restructuring in 2018. But on the other hand, we had him on the opposing side when he was advising Zim on the restructuring of Zim. But, we managed really to go through, in all these situations, practically to the benefit of the industry and all the companies involved. So yes, it started in 2006. After our IPO, we entered the financial crisis with about 30 vessels on order. The good thing is that all of them were with long-term, with 12-year charters. So there was no actual, let's say, spot exposure. We had arranged for the financing of quite a few of them. We had already paid 40% of the equity of all these vessels. And, but of course there was still, out of all these huge new building program, there was a small, let's say, gap. Well, small. It was an $800 million gap, but out of something like $3.5 billion program, that was not really huge. right, on the basis that we had already the employment, we had already put up the equity. And then, what is really the interesting thing is that because we were advised to be cautious by all our financial advisors at the moment, we said, okay, we have fixed the ships, we had fixed the charters. What is really the moving part is interest cost. So we said, okay, let's fix the interest cost, and we are bulletproof. So that's exactly what we did. And then when in 2008, the whole credit market collapsed and interest rates went down to zero, we had a mark-to-market negative valuation of the swaps that we had fixed of approximately $800 million. And people do not realize it's exactly this 800 million mark-to-market that threw in a mess all our covenants, and we could not even draw the facilities we had already arranged. So it's a very weird, how can I say, exercise. People do not realize exactly, what happened, but basically, we had to fight for a cautious decision that we took at the time. So, this is an important lesson that sometimes some movements that we're doing to hedge, we don't know how the situation is going to develop, and they might backfire, no matter how cautious they might have been at the time. Anyhow, the good thing is that we've managed really to do the refinancing at the time. The company went through. Then the next hurdle came when ZIM really started having problems. And my friend Mark here came and asked for charter rate reductions.
I was very polite.
It was quite a process. But in the end, we've managed really to go through the ZIM restructuring. At that time, our, let's say, charter loss from the ZIM transaction was approximately 200 million. Out of that, we got 50 million in bonds and 150 million in equity. And we became, the second largest shareholder. At the time, to be honest, the book value of this equity was zero. We had it as zero in our books. At this moment, the overall, let's say, recovery of this 150 million is close to 600 million, which, to be honest, it's the least investment recovery that we could have ever imagined. We had it, as I said, a zero in our books, and we would have been very happy at the time if ZIM survived and managed at least to pay the balance of the charters, which were still above market at the time.
So maybe to just jump in, and we should have called this making lemonade out of lemons, perhaps, because that's in fact what you did with ZIM. It was remarkable. But maybe to just finish off on the second sort of restructuring, and then we'll get into the fun stuff, which is, talking a little bit more predictively about the market. Can you hear better now? The restructuring that really got caused by ZIM's cash flows diminishing and then the double whammy of Hanjin and HMM, left you in a position that just as your debt was maturing, you had significantly less cash flow. And John was literally, if we had to rename him, maybe it's Houdini, because in a situation that was really challenging, John was able to get over $500 million of debt forgiveness from the banks. He was able to negotiate a discount from the hedge funds and still maintain for his current set of shareholders a majority of the equity. It's an outlier outcome that I've never seen before or after. And so maybe instead of continuing to boast about it, maybe, John, the question is, what was it about, the company or, your ability to have credibility with your constituents that you felt led to that outcome?
Well, I think that, goes back to the whole history of the company. We have always been extremely honest and transparent, and no matter what the difficulties, we were always there, to provide, full accountability of what was going on, and, of course, additionally, to be able, as a main shareholder, really to put money back in the company. Because in the end, it's fine, with bankers saying, okay, I trust you, but in the end, this trust has to be translated by putting your hand in the pocket. And in the end, and this is true even from all public companies, when in the end, the situation comes to a halt, the banks will look at the main sponsor to really to be able to contribute and to be able to show his commitment, not just in words, but actually by actually risking himself together with them. And this is exactly what happened in 2018 with our big restructuring. It's very simple. We put with all the numbers down, all the presentation, with all our lenders were convinced that this was by far the best scenario for all of them. I mean, when you had, for example, funds offering them at the time something like 25 or 30 cents, and through the the restructuring proposal, they were getting at least 60 or 65. I mean, that was a no-brainer for them. And I can tell you that actually that debt-to-equity conversion happened with a 1.2 billion company valuation. So actually, if someone had kept, let's say, the stock, they could very well have made money if they had sold, for example, at the top of the previous cycle, where the company's market cap went up to about 2.2 billion.
But just for context, the market cap was closer to 100. So, the valuation that was implied, that's part of the magic here. But given time is diminishing, I'd want to focus on, your perspective, John. You've now, as a result of the Zim ownership and all the dividends and value that got created, plus just the higher freight market, you've gone from being, reasonably highly levered to now basically being unlevered. And you've put yourself in a position to be much more opportunistic now going forward. The market's obviously softening, and so, now you're faced with, I'm sure, shareholders that would like capital back, but I assume you see, the future with, asset values cracking and opportunity set being, more robust. So maybe give us a little bit of a sense for how you're thinking about the go-forward investment strategy.
I think that we are in a different type of cycle this time, because in the past, when we had, for example, back in 2008, we had, of course, a destruction in demand, but on the other hand, we had interest rates at zero, which meant that the carrying cost of the asset was extremely low. Here we are today in a completely different environment. We are running at inflation, of 10% and above. Interest rates, no one knows where they are going to peak. If you see all the graphs of where inflation was projected to be, interest rates were projected to be, back in, for example, in September 2021, and then in December, and then in March, and now, every graph is going higher. So people are saying that the Fed is going to plateau at 4.5. Nobody really knows about that, because as you see, the US economy doesn't look really to be dented by interest rates yet. So what's the result? That the carrying cost of an asset is becoming pretty expensive. Easily, bonds today, a double-B bond is close to 10%. So really, debt costs at these levels, although they are not unnatural if we look at, a horizon 20 years ago for shipping, but we've been used to very low interest rates for a very long time. And this has made us a bit complacent about really what the servicing of debt, let's say, looks like.
So John, that would imply to me that prices should come down quite a bit, unless charter rates stay high, to get to required rates of return.
Yeah, well, prices at this moment, to a significant extent, are, let's say, pegged by new building prices, which are up. Now, with inflation, maybe, new building prices, given, let's say, the order book, will not fall significantly. On the other hand, if you have a ship that you cannot really service the debt, that is irrelevant with the market. Because here we're talking about demand in all sectors. Of course, the container ship sector is, let's say, the worst in terms of order book compared to the others. On the other hand, the container sector is the one that has historically the biggest growth to be able to absorb that, and also because the container ships account for more than half of the consumption of fuel oil in the maritime industry, are the ones that will require to slow down a bit to be able to save on fuel oil and comply with regulations. But here, with everything, all the banks in the world are raising interest rates with one sole result: to curb prices, which, in order to do it, they have to curb demand. So it's not a question here of, let's say, order book. Of course, a large order book makes things worse. But if demand goes down, then there is nowhere to hide.
Interesting point. There's so many topics we won't get to, but one of the things that we've seen over the last couple of years with the liner companies doing so well is they had so much money to invest in new assets. Now the competitive set's sort of interesting. On one hand, in the past you had the KGs and a lot of financial institutions that were interested in investing in container ships. Those market participants are less present, but a bigger piece of the pie is owned by the liner companies in terms of assets. How does that change the competitive dynamic in your mind?
Well, liner companies practically, have historically, they have been better, let's say, credits than the owners. So the owners, in order to make money in that industry, had to be, pretty creative. I mean, the only when this big, outsourcing started, which was prior to 2008, I remember that we could source debt at something like 65 basis points over LIBOR. And of course, at that time, Maersk was sourcing debt at 30 basis points over LIBOR. So it was a pretty small difference for them and for all the other liners to be able to pass on the risk to someone, because for ourselves we could very well let's say be competitive. And the other most important thing at that time, with the current IFRS leasing rules, all this liability was off the books, which meant that they could incur, let's say, a huge kind of off-balance sheet liability without reporting it, which would not affect their covenants, etc. I mean, today, this has changed. All that liability goes in their books, and in this respect, they don't really gain very much by doing it. So that's why the incentive for them to outsource this function is definitely smaller. And that's why that we have seen, especially now that they are, all the liner companies are cash rich, most of the new building projects are really controlled by the liners themselves.
So it sounds like the business almost becomes more of a trading and short-term oriented business in terms of market participants like Danaos.
Yeah, I mean, you will need to be much more imaginative. Yeah. You will need to take more risks than in the past. You need to position yourself and wait really for the timing opportunity of the ships that you have ordered. I mean, the model of, let's say, ordering the ship, chartering it long term, it still exists, but you will need to compromise with very, very low single-digit returns.
Fascinating. Well, John, really candid, great stuff. I think we're being told that we're at our end and disappointed we didn't get to all the topics, but thank you very much for sharing the stage with me today.
Thank you, Mark.
John, thank you, Mark. Fantastic job. What a remarkable story that the company has been, John. I mean, if there hasn't been a case study written about this yet, I'm sure there will be, or should be. We have time for one question, and Antonis?
Καλημέρα, κύριε Κωστά. Είμαι ο Αντώνης Γολαμνίδης από την HSBC. I would like to make a question to you. If you remember, back prior to the 2008 new building program of the company, if you were obliged by the banks to enter into the swaps? I mean, if it was a part of the contract. One question is that. The second is the duration of the swaps, and if the swaps were plain vanilla ones or structured ones. That's all. This is, I think, a good lesson for all the bankers being present today in this event.
Thank you.
Yes, thank you. No, we were not obliged. But, at that time, because interest rates were increasing, we thought that it was going really to solidify our story, because that was the only moving part. And they were just plain vanilla 5-year swaps. And actually, there were forward swaps from the delivery of the ships.
So just to follow up, John, I mean, what is the lesson learned there? I mean, you were trying to match your liabilities with your cash flow, and obviously it went badly wrong, like $1 billion wrong.
Well, you see, it went wrong from a balance sheet point of view, not from a cash flow point of view. And that's why with all our model, all through the years, our cash flow was always very strong. Even after the collapse of Hanjin, during all the discussions about restructuring, what is fascinating, we were always current with all our debt repayment. I'm not talking about interest, even the debt repayment schedule. And that was because we had very strong cash flows. It was always a balance sheet. But, to be honest, the morale out of all this story is only one, that in shipping, the most important thing is really to be able to stay alive during the downturn. If you're able really to ride the cycle, there will always be a time that you will be vindicated. So that's the only lesson. It's a cyclical industry. No matter what kind of model you have, there are always risks. And the important thing is staying power.
There you go. Well done.
Thank you.